Good afternoon. Welcome to the FTD University webinar titled Payroll, Targets, Analysis, and Incentives. Today, you will learn some important measurements regarding one of your biggest expenses, which is payroll. Learn key targets for profitability, how to analyze your sales, and incentives that are working for others. Derrick Myers, a certified public accountant and certified financial planner and president of Crockett Myers & Associates, will be leading this informative webinar. As a business consultant, Derrick has developed financial strategies that are unique in the floral industry and have proven instrumental in the growth of many florists. While working with the floral industry since 1983, Derrick has perfected his floral analysis program, which allows him to break down financial statements to show owners where to focus their time and energy to reduce costs and increase your profits. He also provides the expertise to guide businesses and individuals toward their financial goals through management advisory services, as well as tax, estate, and financial planning. Once Derrick is finished with his presentation, we will open the webinar up for questions. If you have a question, simply type it in that question box on the upper right side of your screen. Feel free to submit questions during the presentation as well. So without further ado, I would like to turn the call over to Derrick to begin the webinar. Derrick?
Good afternoon, everybody. My name is Derrick Myers. I just want to congratulate you all for being at this webinar today. What we find is about the top 10% of businesses and industries will actually try to learn more about what they're doing. So this puts you in the top 10%, the fact that you're attending this seminar. And I just want to congratulate you for making the efforts to improve your business. So today we're going to be talking about payroll. And payroll is one of the big three areas that we focus on. The big three, the first one, of course, is cost of goods. Payroll is the second largest expense that we have and the second area that we need to focus on. And the other area that we really need to look at in our businesses is delivery. So those three areas, if you're off on any one of those, you can lose the profit from your business. So any one of these areas can pretty much take the profit away from your business and you end up working for nothing. So we don't want you doing that. So we're going to be walking you through some targets and some things today to help you control payroll and understand how to hit the targets that you need and know whether or not you're hitting them, and then maybe even how to incentivize some people to help them become more efficient and help them, bring you toward these targets as well. So that's kind of our focus today. This seminar is going to be done in two parts. Today we're talking about the targets, the analysis, and the incentive side. In November, we're going to do part 2, and we're going to talk about budgeting and how to plan your schedule so that it's going to hit these targets and be where it needs to be to make you as profitable as you can. So today we're going to be talking about targets to begin with. And anytime we want to analyze any section of our business, in order to know what we're going to do, we have to first know what our targets are. So we need to know what our targets are if we're going to analyze anything. And if we're going to try to incentivize, we have to make sure we're hitting those targets and or build incentives that will get us to those targets. So the first thing we have to do is know what our targets are and what should we be striving to hit. Anytime we're dealing with targets, one of the most important things we have to do is make sure that we're looking at them in a consistent manner. That what we're comparing to, we're comparing the right thing, and we're comparing it the same way all the time. One of the biggest issues with the industry is a lot of people throw percentages out there, but we don't always know what's included in them, or what we should or should not include when we're comparing to that target. So that's one of the things that we're going to do today. We're going to not just show you targets, we're going to clarify what's in them and how to calculate them, so that when you're comparing your results to these targets, you're comparing apples to apples. Okay. So along that line, let me explain a little bit about who we are. So for those of you who don't know Crockett and Myers and myself, we've been in the industry since 1983. We started working with our first florist. And we are, as far as I know, one of the only accounting firms that actually do accounting for florists and do business consulting as well. So we go back and we take the financial statements and we break them all down and rebuild them from the same structure. So we have 122 clients that we work on a monthly basis, and we basically pull the sales from their POS system and break them down into the structure we want. We bring the wire service information over and break all the expenses down the way we want them. And we make sure that when we're comparing one shop to another, everything is being done in the same manner. So all of the expenses are being calculated in the same manner. Everything that's being included in the percentages is being done in a consistent manner, so that when we compare them, we're comparing apples to apples and we're getting good comparisons. So our 122 florists represent 36 different states, and they also represent the gamut in size. We go from a very small shop, somewhere about $150,000 in sales annually, to shops that do over $10 million annually. So we have shops of all different sizes. About a third of our shops are what we consider large shops, $1.5 million and up. About a third of our shops are between $750,000 and $1.5 million. Those are medium-sized corporations or companies. And then 750 on down, we consider those small companies. Now, that's very important when we're looking at certain targets. Certain targets are affected by economies of scale. By the bigger you get, the cheaper you can buy things. One of the main ones is cost of goods. Cost of goods is very much impacted by how much volume you do. Of course, the more you buy, the cheaper everything gets. Okay, payroll is not affected by volume. It's one of the few things that we find a man hour costs the same whether you're doing $10 million or whether you're doing $150,000 a year. That hour of somebody's time costs about the same, and the percentages hold very consistent all the way across the target, so, the size of the company. So when we look at our targets today, doesn't matter if you're a $10 million company or a $200,000 company, these targets are going to be very consistent and they're going to work for all size companies. Okay? So that's kind of who we are. It's a little bit of a background. So let's talk a little bit about targets. When we're going to look at targets, one of the things that we do that's kind of different is we use inventory sales. Now, for those of you who aren't familiar with the difference with inventory, or some call it product sales, versus gross sales, let me give you a little example real quick of what we're talking about. So gross sales, now most of the time when I come into a new shop and I look at their financial statements, this is what I'm going to see under the sales section. I'm going to see cash sales, check sales, AR sales, wire service sale, or wire in sales. Really what we're looking at here is what was the method of payment? Okay, so a lot of the POS systems, well, this is their default. They'll default to method of payment as the sales category. And then we also have the other income stuff, the delivery income, the service and relay charges, and the outgoing orders. Now, method of payment is nice to know. I mean, it's valuable when you're trying to analyze cash flow. It's nice to know how much of your business is accounts receivable sales versus accounts receivable versus cash. A shop that has more cash sales is going to have better cash flow. Somebody who has a lot of accounts receivables, you're going to see a lot of money tied up in receivables, and your cash may not move quite as quickly. So understanding where your sales come from can have some value to you. But we find the inventory sales to be more valuable when we're analyzing the business. So the difference is inventory sales, instead of looking at how they were sold or how we got paid, we want to know what we sold. So we're looking at the product sales, what was actually sold. So on this side, we're looking at how much did we sell in fresh flowers and plants and balloons. To me, these have a lot more value because now when I'm looking at cost of goods, I can look at the fresh flower sale compared to what I'm spending in fresh flower cost, and I can determine if I'm hitting my targets. Okay, so this gives us a little bit more detail. What we do that's kind of unique from anybody else that I know of in the industry is all of our percentages are based on inventory sales. So once you set up your profit and loss statement to have inventory sales at the top, all the percentages will automatically calculate with most POS systems, or if you're using like QuickBooks or something to do your accounting, all of your expenses will be benched off of the inventory sales number, and you can very quickly compare them to our targets. So it makes it a lot easier. The rest of the other income stuff, the delivery, the service, the relay, all of that goes into an other income section, goes down to the bottom of the financial statements. Again, what we're trying to do is boil this down to the easiest common denominator, which is product sales. It's much simpler. The other items can vary too much, which can skew percentages. For example, I have some shops that charge $5 for delivery still, as hard as that might be to believe. I have other shops that are charging $18, $19, $20 per delivery for base delivery. So a shop, if I add all that into sales, it's going to distort the mix, and it's going to make the percentages not as valuable. So by separating this stuff out, the inventory sales give us a much cleaner base to base all of our percentage on. So that's what we do. So inventory sales is what you need to work on. If you have any questions about that, feel free to email me later. I'll be glad to give you more information on how to structure that, how to get your point of sale system to maybe dump that into QuickBooks for you, get that kind of stuff done. But That's the thing we need to look at. All right, so now let's talk targets. Let's talk payroll. First payroll target I want to look at, because I just want to get it out of the way, and that's owners or officers payroll. And the reason I say I want to get this out of the way is because owners payroll is probably one of the hardest things to nail down in the industry, because, and I'll explain why. Our target is 10%. So theoretically, we're looking for owners and officers to pull about 10% out in payroll, and then we should have 10% left in profit, and that's 20%. That's pretty much the industry standard as a 20% target. Now, for those of you who know the industry well, the average is actually only 8% combined. Owner salaries and profit, 8% is the industry average. Our shops average much higher than that, probably about 16%, and our highest profitable shop is at 26.5%, counting owner salaries and profit. So there is a lot of money to be made in this industry if you get all the targets in the right place and all your numbers in the right place. So our target is 10%. Now, why is this a muddy target? Why is this one hard to look at? The problem is, depending on the entity that your company is in, it's going to affect your payroll. For example, if you're a sole proprietor, meaning that you are a Schedule C business, basically you don't take a salary as the owner. All of the profit at the bottom is your profit. It is your salary, okay, as a sole proprietor. A partnership is the same way. I mean, you can have some guaranteed payments in a partnership, but generally, whatever profit is shown at the bottom line, that gets split between the partners. Okay, so that is the payroll and the profit. It's all one big number and it gets squished together. Now, if you're an S corporation, then we tend to, we have to take what's called a reasonable salary, which nobody can actually really define, but we play with that as much as we can. But typically we push the salary down as low as we can in the S corporation because we're trying to minimize the payroll taxes. So we might push it down to 5% for owner salaries in an S corporation and let the profit go up and show more like 15% or so. By doing that, we can save Social Security, Medicare, workman's comp, unemployment, federal and state. Any benefits that are tied to payroll are going to be reduced because we're reducing our owner's payroll. So it saves money by shifting payroll. Conversely, if we're a C corporation, C corporations get double taxed. So if we show a big profit on the C corporation, we're going to pay taxes on that. And then when we take the money out, we're going to pay taxes a second time. So typically, officers will ramp their payroll up to the point that there's no profit on the C corp, and their payroll might be 15, 20%. Okay, so owner's payroll is very hard to nail down, but our target is going to be 10. Okay. I just lost connection, I think. Okay. So you need to know what your percentages really are. So now we have our target. How do we actually calculate that? So the way we're going to calculate that is we're going to look at gross payroll dollars only. Okay. So our interest here, our target here is we're not going to include the taxes, the benefits, or anything else. We're going to look strictly at the cost of payroll, just the hourly rate or the hourly wage. We take that gross payroll, we divide it by our inventory sales number that we talked about before, which is just our product sales. So we're going to exclude delivery and service and outgoing commissions and all that. And we're going to look at strictly gross payroll divided by inventory sales. That's going to give us our percentage. So for owners and officers, we're targeting 10%. That's where we want it to be. Okay, so that's how we do that. Now, benefits, I kind of talked about those before. We're not including those in our payroll numbers. So what should benefits run? Benefits, this is the only percentage that we do in our entire portfolio that is not based on inventory sales. Benefits we look at as a percentage of payroll. So if typically you're paying somebody $10 an hour, the benefits run about 12 to 14% of payroll, which means instead of $10, it's really costing you about $11.20 or maybe $11.40 for that employee. Okay. Now that's typical benefits. That's basically just taxes, maybe a pension plan. If you throw insurance in, health insurance, if you alter health insurance, those numbers can jump up dramatically. They can go from 16, even up as high as 24%. So they can jump very considerably. So this is, again, one of the reasons we don't include them in our calculations, because if you're offering a great deal of benefits, if you're philanthropic and you have high profit and you're offering a lot more benefits to incentivize people to work for you, that really isn't an indication of how much they're costing in payroll. These are additional benefits that you're adding. Okay, so we keep them separate and we look at them separately. So again, when we're looking at payroll, we're looking at just the gross pay. All right. Now, let's talk about overall targets. So we've talked about owners. Let's talk about everybody else. These are what we call a rank and file. Rank and file are all the non-owners of the company. And typically we break that down into several departments. The first one is designers. So designers should typically run about 15% of your inventory sales for payroll. That's their designer's payroll. And again, this is just the hours worked, not the benefits and the taxes. Okay. It's real important because I know there are other percentages out there that'll show you with benefits included and all. And again, like I said at the beginning, the most important thing is to make sure you're looking at percentages the same way they're calculated. Make sure you're doing apples to apples. So ours are just at gross payroll for the designers divided by the inventory sales. Now, in the designer category, we do include processors. So if you have people who are processing your flowers in addition to your designers, we count them in this 15% in this department. Okay. The next department are delivery. And delivery, we're looking for typically 5% cost for our delivery wages. So take our payroll for delivery, divide it by the inventory sales, and we come up with 5%, hopefully 5% or less. Now we have started to see a little bit of minimum wage is starting to have a little bit of an impact on this, at least temporarily. We're starting to see delivery push a little bit higher, but these are still the targets that we're still trying to hold to. Sales and administrative is the next category. So these are your salespeople. If you have any administrative staff, accounts receivable clerks or bookkeepers or anybody doing admin stuff. If you're larger and you have managers, they're going to fall into this category. Anybody that's not, right in the production area that's doing something besides production is pretty much going to fall in this department. So all three of these together come to 25%. So again, 25% for the rank and file salaries plus 10% for the owners. That gives us 35%. And I know a lot of you guys have heard 35% bantered around the industry a lot. But these are the numbers that break that down. Now, it's real important to understand, too, that in these targets, we're including all subcontractors and casual labor. So this is all gross labor, whether it's from casual labor, contract labor, or payroll hours, okay? And the reason we want to do that is because if you have a shop that maybe does a lot of subcontract labor and very little driver delivery salaries, it's going to make, if we don't count those in, it's going to make your delivery payroll look really, really low. But when we add the contractors in, we're going to find that you come back closer to that 5%. So we want to include the contract labor and the casual labor, just not the taxes and the benefits. Okay. All right. So that's pretty much our targets. So again, that's what we're looking for. And again, the way you calculate those is you just take the payroll hours or the dollars in payroll and you divide that by the inventory sales, and that's going to give you that payroll. Those percentages. All right, the next targets we want to look at are production targets. Now, these aren't overall industry targets. These are going to be per person targets. So here's where we're going to want to look at like the designers and how much they actually produce as an individual designer. Each designer should be able to produce 10 times their hourly rate in production each hour. So if you're paying someone $15 an hour, that employee should be able to produce $150 per hour in output. And when you think about that, it's really not very much. Three $50 arrangements in an hour is $150. So that output really means somebody's doing 3 arrangements. So an arrangement every 20 minutes. Any designer worth their salt can easily do an arrangement every 20 minutes. One of the areas that we fall into problems here are maybe they're doing something else. Maybe they're not designing all the time. Maybe they have to do something else. Maybe they have to process their own flowers. Maybe they have to clean the coolers. They're doing things that don't produce, and that's going to have an impact on their hours. The other thing that can hurt this is maybe you don't have enough volume to keep your people busy all the time. And that's when you have to start looking at budgeting. Maybe where we've got too many people on staff and so nobody has enough production to keep them busy the whole time. So that's where these targets come into play, and that's why they're so important. So we need to determine each person's output relative to their hourly rate. So if you take whatever you're paying your designers, multiply it by 10, that's how much they should be producing in product by hour. Now, almost every POS system I know about there, and certainly FTDs, can track designer output. So each designer has to sign off on the arrangements they do, and they get credit for that arrangement, and that will track that output for you. So you don't have to do all this by hand. The systems will track this for you, and then all you've got to do is analyze it. Okay. Same with the salespeople. You can tell who sold an arrangement. You can tell who designed it. You can tell who delivered it. All of these things can be tracked by your systems. Okay. So that's designer productivity. The next category we want to look at are the salespeople. Now, sales staff, if you think about it in terms of time, they should be producing 25 times their hourly rate. Sounds kind of crazy, but when you look at it in terms of numbers, it's not that bad. A $12 an hour person should produce $300 per hour in output, which means they're selling an arrangement, one $50 arrangement every 10 minutes. If they can't take an order in 10 minutes, something's wrong. Okay. Now, again, we have to look at, is all of their time being spent on sales? And if not, we may have to make adjustments for that. But those are the kind of things we have to look at. So $12 an hour employee should produce $300 per hour in output. So again, 25 times. So the same thing, take all your salespeople, take their hourly rates, multiply them by 25. That's what they should be selling per hour. Check your POS system against that, pull the reports that say how much these people are selling, and look at each person and determine whether or not they're hitting their targets. Okay. Production for drivers is a little bit different. Here we kind of look at the number of deliveries per hour or a $30 per hour delivery revenue. So what we've seen as the kind of the break-even point of a delivery, or where you make a little bit of money on delivery, is if you've got the average delivery fee in the industry, which right now is about $10.95. If you're doing 3 deliveries per hour, you're making almost $33 per hour, which is over my $30, which should be good. If they're doing less than 3 deliveries per hour, either they need to move a little bit faster, or maybe you're in an area that doesn't allow it. Like, for example, I have shops that are in Texas, and sometimes in Texas, when you drive out the door, you're going for a couple of hours, and no matter where you're going. So what we find there is it takes 2 deliveries per hour is all the drivers can produce. So what we've had to do is adjust the delivery fee to be $15 an hour, so that we're still averaging a $30 hour production. Okay. So if your drivers can't do it, if it's physically impossible to do 3 deliveries per hour, then you've got to make sure you're pricing accordingly. Now, conversely, some of my clients that are in small towns or maybe big cities, but a small town within a big city, they can do 3, 4, 5, 6 deliveries per hour because everything's so close and they can move so fast. In that case, they're not going to want to send an incentive based on $3 per hour or deliveries per hour. They're going to want to increase that. So that's kind of what we're looking at. So $3 deliveries per hour or $30 an hour in delivery revenue. That's what we're looking at for a target in delivery production. All right. So I've kind of talked a little bit about analyzing these things, but that's what you've got to do. So now that you've got your targets, you've got to look at everything and you've got to analyze it. So you've got to analyze your labor by category. And if you find a category is in trouble, that's when you got to really go into the numbers. So if you find you're heavy in design, that's when you have to really look at your designers individually and their productivity. Okay. So if the productivity is below on some designers, then you've got to work at how do we get them to move up? Okay. And that's really what the analysis is. So the analysis is then just taking the numbers, digging in on your own, and finding out how your people are producing compared to the targets and if you're hitting those targets. So run your numbers, compare them to the targets, see where you need to work. And once you know what areas you need to work on, that's where you want to focus your energy. So if you look and you're perfect on delivery salaries, then don't waste any time focusing energy there. Focus on the areas that are off. If you're high in design, start analyzing the designer hours. Are they really spending all their time in design, or are they doubling on the phones as salespeople? Where is their time going? And once you have those numbers down and you can see that, then you can start to make changes and move people in the direction they need to move. Okay. So now that we have our targets and we've kind of taken a little bit of time to analyze them, let's talk about some incentives. And I've seen incentives run the gamut. And I say it because I've seen some that are so simple, you just go, wow, that's genius, and I'm going to do that right away. I've seen others that are so complex that it takes an accountant, you know, internal accountant probably several days to calculate the numbers, and most of the staff don't even understand where they come from, and it can kind of lose its value. So I feel the simpler the better when you're looking at incentives. You know, if it's something that's very easy for everybody to understand, I think they're more likely to do it and strive for it and work toward it. So here are a couple simple ideas that we've seen throughout the industry. And it's not all of them by any means, but it's just a couple to kind of give you a flavor for what people are doing. One of my favorites is every flower shop I go into, I see tons of old inventory and old containers that have been sitting around for a long time and they're not going anywhere. What I have several shops that what they do is they actually have a shelf of containers right in the design room, and they're old containers. And they're ones that have just been sitting down collecting dust in some storeroom. They bring them out, they tape dollar bills to them, and any designer that can pull one of those things and use them gets to keep the dollar. And it's a very quick, easy incentive. And I'll tell you what, those old containers will fly out the door, and you'll convert that old inventory back into money. And that's one of the greatest little things I've seen. It works really well for designers. Now, if everything you sell is recipeed and on a website, it's very hard to do this. But if you've got some room in your, you know, if your salespeople are selling, you know, designer choice, and you've got designer choice options on your website, it makes it much easier for them to do this kind of incentive. But tape dollars to old containers and watch them fly out the door. And let me tell you what, a lot of these old containers you paid a lot more than $1 for. So if you can use them and convert them back into money, you work out very well. Another dollar idea I've seen is for the salespeople. And that's basically you tape a bunch of dollars to the wall, and basically you set a dollar limit, and maybe it's $100 for your shop. If they take an order for $100 or more, they get to walk over to the wall and ceremoniously grab $1 off the wall, and they get to keep the dollar for selling a $100 arrangement. Now, if your shop, maybe your average sale is $85 and $100 is nothing, well, then you don't do it at $100. You make it $150 or $200. But the idea is you just set your limit, and when a salesperson hits it, they can just walk over and grab $1. It's a great incentive for them to upsell a little bit when they're taking an order. Another cool idea I've seen is a gumball machine. And again, you have to have your things in place. Maybe it's a salesperson sells a $100 order. Maybe it's a designer uses an old container. Instead of using dollars, I've seen shops take a gumball machine. And what they'll do is they'll give you a quarter for the gumball machine each time you hit one of these markers. You go to the gumball machine, you take out a gumball. The gumballs are color coded. If you get a yellow gumball, it's $1. If you get a red one, it's $10. If you get a black one, it's $100. Of course, there's not very many black ones in there, but that's the idea. That the whole thing with these is to be creative and to be fun and to do things that are going to work for you. Okay. Another one I've seen is a bingo game. Same kind of thing where you get a bingo token for, you know, which has a letter and a number on it for each goal you hit or each marker that you hit. You take those and you have a card, and whoever gets bingo first wins a prize. Maybe it's money, maybe it's a lunch, whatever. But you just set up something that's going to work for you. Another great little add-on, great little incentive is money for add-on sales. So maybe somebody does an add-on sale, they do a balloon or they do a bear, and they get an extra $1 for each add-on, or you know, something like that. So you know, you can make a lot of money. You know, if somebody gets an extra $20, $30 in their check over the course of a month, they're going to be really happy with these kind of incentives. Or if they're taking dollars off the wall for old containers, I mean, it can add up to be quite a significant little boost for them over time. The whole trick is to be creative with your incentives and come up with your own. Come up with your own incentives that reflect your style, your shop and its style. Okay. You know, one of the things that we'll talk about in a little bit is taking somebody else's ideas don't always work. Okay. So let's talk about specific incentives for some targets now. So how would you reward a designer? So again, a designer, we said, should produce about 10 times their hourly rate each hour. Okay. So, you know, $15 hour designer should produce $100, $150. If they're producing 170 instead of 150, well, then we should reward them for that. Now, I'm not saying you check this the first time. If they're over this, immediately you reward them. But what we do want to do is look at look at what they're doing in terms of target. If they're already producing 170, we may want to set their reward at $180. If you can up from 170 to 180, we're going to give you a little bit of a reward, and that reward could be as much as, like in this case, $170 really means this person is producing at the rate of a $17 an hour employee. So we could bonus them as much as $2 more and still keep our percentages in line. Okay, but again, I would want to keep it separate as a bonus or an incentive and not just change their hourly rate, because if their production drops, it's harder to take their salary back down. But if their salary is $15, we're giving them extra money as they produce over. When they fall below, then we still only pay them the $15. We don't pay them any kind of incentive. Now, conversely, if they're below our target, we need to discuss with them what's going on, and we need to hold them accountable. We need to start coaching them in how to become more productive, get them moving up in the production, and if they can't, then we need to either let them go or reduce their payroll accordingly. So if they're producing at in this case maybe $120 an hour instead of $150, they're really only a $12 an hour designer. So we either have to reduce their pay down to $12 an hour or help them get up to that $150 per hour in productivity. Okay. Incentive for designers, our salespeople, same kind of thing. Again, we know our target is 25 times the hourly rate. So if they're producing in excess of their target, reward them for it. Give them more money. It may not always have to be money. It could be just a lot of times attaboys go a long way. Just telling everybody, hey, this is my #1 sales producer, and letting everybody know. Maybe having some other kind of rewards like a lunch, or whoever has the best percentage increase in sales production gets something special. Again, make it special for your shop. Make it something unusual, something different. And again, if they're below this target, you've got to hold them accountable. Either get them to improve in their sales stat and what they're doing, get them some education, get some training with them, do whatever it takes to help them get their production up. Okay. And if they can't get their production up, then you're going to have to, either reduce their salary or get rid of them. Find someone who can do it. Drivers, again, should make at 3 deliveries per hour on average. I'm kind of hesitant and a little apprehensive about incentivizing drivers, because I feel like, if you want them to speed up, you're kind of giving them a license to speed in your vehicles, and that can be very dangerous. And we don't want our people out there being unsafe. One of the best ways I've seen drivers being incentivized is actually if they're paid by the package. And just to kind of let you know, on average, if they're driving your vehicles, average pay is about $4 per delivery. And again, I said 3 deliveries per hour, that would be $12. So if they're doing 3 deliveries per hour, that's going to be a $12 hour employee. If they're doing 4 deliveries per hour, they're making $16. So that can be a really good incentive for a driver to kind of hustle a little bit out there, knowing that they're going to get paid by the hour, or by the piece rather. If they're using their own vehicles, that payment needs to be about $7 per hour to help cover the cost of the vehicle as well. So it's just kind of where we are on those. The biggest thing is with all of them, and whatever you do, you've got to be fair about your targets and about your application of these targets, or else the people won't care and they won't do anything. So if you're not consistent across the board with everybody, if you don't treat everybody the same, if your targets are unreasonably high, too far for them to obtain, they're not even going to try. So you've got to keep them within an area that they can try to get to and that they can try to accomplish them, or else they won't even try for them. They won't even do them. Okay. The next category of incentives are what we call group incentives, or incentives just for managers. So these kind of incentives are based on a target. Like the example that I see all the time is cost of goods. Again, I told you before in the beginning, cost of goods are the #1 cost center of a florist. So this is the area that I see a lot of incentives focused on. And here they might say to the whole group, they might say to all the designers and the whole staff, say, look, if we can bring cost of goods down from 34% to 32%, I'll take $1,000 and split it amongst all of you. And if there's 3 people, that's quite an incentive. If it's 20 people, it may not be quite as big, but it's still a nice little pot of money, $50 a person. But that kind of incentive can go a long way if the people feel like they have control. So you have to make sure they have control of the situation and they can actually impact it. So if it's a designer, they know they can count the arrangement. They can make sure they're not overstuffing. They can do things to control cost of goods. If it's a buying agent, purchaser, they can make sure they're not overbuying or that they're buying the right product. Managers can make sure that people are working up to speed and doing what they can do. But some people may feel like they don't have any control of this. So you may have to either exclude them from this target or try and get them to buy in some way. Another kind of target might be payroll related. Maybe we say, hey, look, guys, if you all work a little bit harder, help me get my cost of payroll down from 28% to 25%. We'll have a staff party, or we'll have lunch in, or we'll do whatever. Again, try to pick targets that are going to be easy for them to see and obtain, and that they can have an impact on. Right. The problem that we see with group incentives, the difficulty is that, again, sometimes they're just too difficult for the employees to understand. A lot of employees don't even understand cost of goods, and you've got to make sure that you explain it to them and they understand it. Because if they don't understand the incentive at all, or they don't understand how they can impact it, again, they're just not going to care about it, and they're not even going to try. So again, try and keep incentives simple so that the people understand, and if they can understand them and they can impact them, they're going to work for them. The other problem we have with group incentives is that it's a team activity. Everybody's got to work together as part of the team to get this to where we want it to be. If we want to get cost of goods down, it takes everybody working on cost of goods to bring it down. And if you have some non-team players, some prima donna designers or somebody who just doesn't really care, and as I would say, they're not part of your A team. I mean, to me, if you have your A team in place, then you're gonna, if you have all A team players, they're all going to work toward these things, and you're not going to have anybody who's not a part of the team, because if they're not being part of the team, they're working against you. So having everybody on the same team, having everybody working together, trying to get these incentives is crucial, and it's really going to help you get to where you need to go. The last couple of things, basically create an incentive program that's it's got to be very personal and very customized to your business. Like I said earlier, I have a shop who has a incentive program. It works extraordinarily well for this particular shop. And he took that same incentive program and worked with another florist and went through all the things, got it all set up in exactly the same way, and it failed. And it works wonderful for one shop, and it failed miserably for the other shop. And the reason is, I just don't think it spoke to the team. So on the one company, it worked very well. The team was all part of it. They were had bought into it. On the other company, I just don't feel it spoke to the team. I think it was a different kind of a generation. It might have been a younger team. I don't know. But it just didn't speak to them, and they never bought into it, and it failed. So again, don't necessarily grab somebody else's ideas. Work on your own. Figure out what's going to work with your team. Talk to your team. Find out what motivates them. One of the things you got to know is, if you know your team and you know what inspires them, you're going to be able to build an incentive program that works. You have to know each person individually. Some people are motivated by money. Some people are motivated by praise, and some people are motivated just by being part of the team and working together. The whole thing is, everybody's got to believe in the business that they're working for. They got to believe in the directions this business is heading, and then you've got to help them set incentives that are going to make sense and help reward them for moving in the direction that you want to go. That's pretty much it on incentive programs. I'm not going to get into much more detail. If you want some more specific examples, or if you want to bounce some ideas off me, I'd be glad to have you do that. Otherwise, I think I'm pretty much done, unless we have any questions.
Derrick, thank you for sharing a lot of great information with us today. As Derrick said, we've got question time now, so we're open for questions. If you have a question, simply type it in that question box on that upper right side of your screen. We do have a question from Stan. He said, what if sales volume is not enough to make the incentives possible?
What if sales volume is not enough to make the incentive possible? Well, I would think the incentive would always be possible if the production is there. Now, if you got one person, maybe one designer, and there's not enough work to keep that person busy, then I don't think there's any way you're going to be able to incentivize them. You can't incentivize someone if they're not, if they don't have enough work to keep them busy. The whole idea of incentives is to make them work more efficiently and more effective. If the work's not there, I don't think there's much you can do. I wish I had a better answer for that one, but I really don't see how you can incentivize someone to sit around and wait for work.
All right, thank you. We've got a question from Will. When you were just talking about team incentives, you mentioned an A-team. What is that?
Yeah, the A-team that's one of my things. Basically, when I look at employees, I dissect each employee and I label them either an A, B, C, or D. And an A employee, just so you know, those are the ones who are very, very skilled at what they do. They're great designers or whatnot, or great salespeople, and they're also a team player. They're part of the team. They are all in when it comes to the direction that the company's moving. And then you have Bs. And for those of you guys who actually went to school when they graded you, you remember B is not quite as good as A, and C is not quite as good as B, and so on. So Bs, they're team players. Boy, they really are part of the team. They are really wanting to grow and do things, but their skills aren't quite there. So we need to train them and teach them a little bit more to get them to be A's. C's are people who have good skills, but really aren't quite team players. You know, maybe a little bit of a prima donna, don't want to be part of the team, just want to do their own thing, hang out, and aren't really part of the team. And then the last one are D's. And D's, they don't have any skills, or at least not good skills, and they're not team players. And I always get the question, well, why would we ever have a D? And all I can think about is, you know, it's February 12th, and we're 2 days before Valentine's Day, and we need somebody to answer the phone, and somebody walks in the door and we say, you're hired. We don't even ask them any questions. And so as florists, we tend to be really quick to hire people, and then we tend to keep them around forever. So we'll hire these Ds that don't have any skills just because we need somebody to answer the phones, and then 3 years later, we still have them. So our whole thing is building your A-team is how do we move these people up or move them out? Either we take a D and we move them up to a B or a C, or we get them out the door. Either we take a B or a C and move them up to an A, or we get them out the door. That's what the A-team is. So when you're done, all of your employees are A's. They're all great, skilled people who are working really hard on the team and really helping you move your business in the right direction. And if you got a team of A's, they will take your business wherever you want to go.
All right, thank you. As a reminder, if you've got any questions, simply type those in that question box on the upper right side of your screen. We have a question from Jessica. She said, if you pay drivers per package, is that still payroll? And then what about doing a minimum wage?
Yes, it is still payroll. I mean, if you're paying them per package, you can have contractors, but contract labor typically they have to use their own vehicles, their own stuff. I mean, true contractors are a separate thing, and we're really not getting into that today. But yes, I'm talking about paying these people by package on payroll. So if they deliver 3 packages an hour, they get $12 an hour in wages. You do have to make sure, though, that they're being paid at least minimum wage. So if you add up their pay for the week and per package it's less than the minimum wage in your state, you're going to have to pay them at least minimum wage. So yeah, I think that answers that question.
All right. Well, it looks like we're out of questions for today. You apparently did a fantastic job of answering all the questions, or you just gave them so much, Derrick, to think about that they're still thinking. But Derrick's email is on the screen for everybody, Derrick@crockettmyers.com. So if you have any questions, things come up, he's happy to answer those questions and help you. We just want to thank everybody today for attending today's webinar. If you missed a portion, you want to watch it again, I know there was a lot of really great information in there. The replay will be available on FTD Mercury Network's Florist YouTube channel later this week. And the webinar materials, the PowerPoint is available at ftdi.com. And as always, we're going to send you just a very brief survey to gather the feedback on today's webinar. Please ask you to just take a minute, complete the survey, give us your feedback, and help us improve future webinars and other education programs that FTD is bringing to you. Our next FTD webinar is scheduled for Tuesday, September 18th. FTD Product Manager for E-commerce, Tim McIntyre, is going to share 5 tips to help you harness the power of Google to drive more high-quality traffic to your website without paying for advertising. The registration is available already at ftdi.com, so please be sure to register as soon as possible and reserve your spot. And just want to thank you again, Derrick, for sharing a lot of great information on payroll. We look forward to the second part of the series in November. And this concludes
You're very welcome.
FTD's webinar, Payroll Targets, Analysis, and Incentives. Thank you, everyone.